Experience the most efficient system for delivering sulfur and phosphate to meet your crop's needs with Smart Nutrition MAP plus MST.
Sean Haney here with RealAgriculture.com and Real Ag Radio, Rural Radio 147, Sirius XM. We're going to talk about what's going on in the business world around food production and farming. Joining us right now from Capstone Partners is Jerry Sturgill and Skye Root. Guys, how are we doing?
Good. Doing great.
Yeah,
Thanks for having us.
Yeah, well, it's great to have you. So before we get into the report you recently published, Jerry, why don't we tell us about Capstone. Who is Capstone?
We are a middle market investment bank focused on helping companies in North America, around the world. We happen to be the ag practice at Capstone, and as investment bankers, we help farmers and farm-related businesses do transactions, either selling, buying companies, buying assets. We also help farmers and farm-related businesses raise capital for growth. And so we are traditional investment bankers in that sense. We're one of 15 verticals at our firm, and many of our verticals have relevance to the ag world, including logistics, industrials, chemicals, energy. Food. We have a food group. We have a beverage group. Technology. We are able to deliver services to the agricultural sector. In our practice, in particular, we focus on production. And so the report you've seen that we published recently is about production ag, but we also focus on ag inputs and ag tech. We have an international reach because we are affiliated with a network of similar investment banks around the world, and many banks in the major ag markets throughout the world, including Brazil, Australia, Europe. And so that's a little bit about Capstone.
Yeah, well, I appreciate that. So let's get into the report. There has been a lot happening in the sector. We have seen commodity prices move their way to the downside of the equation. We know where we are in the cycle, but we've seen the stabilization or the stickiness of input costs. And let's talk about, from a macroeconomic sense, the overall health right now of the production ag sector. What did your findings tell us?
Well, it's been a tough time since 22. Gross farm income has declined. Input costs have increased, and so farmers have experienced squeezed margins. Net income, average net farm income has been down. And so farmers are trying to deal with that, trying to accommodate that.
And there's also second derivative things that end up happening when those things occur from the operational standpoint. So you end up with farmers unable to put on their normal input amounts, and that leads to, or not be able to upgrade equipment or a variety of things, not hire that marginal labor, and that leads to lower yields, lower efficiencies. And so we're seeing that all throughout the system.
Yeah, there's like a trickle effect in the overall ag economy. When farmers aren't, doing super well financially, it has an impact on the whole sector that supports that primary production for sure. So one of the things that concerns me, guys, is that you talk about your report forecasts a stabilization in the sector by 2033. Now, that's a long time from now. Talk about that, and what are some of the key indicators we should be following to know that we're headed towards that stabilization that you're talking about?
Well, listen, we hope it happens much sooner in terms of the way this actually plays out. But the reality is there has to be significant relief on the macroeconomic side, tied to input costs that we just talked about, less volatility in commodity prices, stabilization of supply chains. I mean, the reality is, I think some of the signals that will show us we're headed in the right direction are a convergence of we've seen double-digit increases, in some cases almost 50% increases in things like fuel costs, fertilizer, labor, equipment costs, and pricing has been flat to down. And for things to be long-term sustainable, there has to be a convergence there where your input costs, all of them mentioned, but particularly those big four, fuel, fertilizer, labor, and equipment, they can't be inflating at significantly higher prices than we're getting in the commodity markets. That's the biggest signal to sector recovery, I think, that will show us we're going in the right direction long term.
And so in the short term, what are some of the things that you see farmers doing to cope with some of these financial pressures over the next few years? Because you got to get to the other side. Let's just say you're correct, and 2033 is kind of the date. You got problems, and that's a long-term problem. But there's I got to pay bills between now and then. So what are some of the things that you see producers doing?
Yeah, so there are certain commodities that are historically live pretty razor thin. The reality is it's going to be challenging. It's going to be challenging for everybody. With a few minor exceptions. There's more systemic distress in the system that we haven't seen this much distress since 2008 in the entire system. But one of the fundamental things I think farmers can control is they got to pay attention to their costs. They got to control what they can control there. They need to hedge revenue where possible. They need to adopt affordable ag tech to help them with efficiencies and management decisions. Crop diversification, water savings. There's all sorts of different things that they can do that doesn't add to their marginal cost that will help them either enhance revenue or at least keep things at a break-even, stable position while we get through this. And that's what they're going to have to do in the short run.
Okay, so your report also talked about M&A activity. So when we're talking about mergers and acquisitions, are you talking about in the industries that support primary production, or are you talking about primary production itself?
Well, it's some of both. I mean, it's on the production side. Certainly, the improvements as the different strategies are implemented that Skye just talked about, which leads ultimately to better margins, should increase M&A activity. That is buying and selling of farm-related businesses on the production side. That's both production and processing. We see a lot of opportunities for farmers to integrate operations that are compatible with their production. We would expect that reduced interest rates are going to help drive M&A activity. And of course, as we've noted in our report, consolidation continues.
And is that a quest, the search for scale to spread those fixed costs out over a bigger breadth of company? Or what's the main corporate strategy during a time like this when it comes to M&A?
Well, I think it is that. I think it's to achieve efficiencies of scale, to diversify risk, to acquire more market power through more market share. Those are the things that drive M&A activity in virtually every sector, but I think it's especially true in the ag sector.
Do you see that being a major issue? Like, if you remove ourselves from the primary equation for just a moment, do you see that happening in the equipment space, in the seed space, in like all of these industries that support the farmer? Yes, for the same reasons. I think there are always opportunities to gain market share and achieve efficiencies of scale. And so, yes, there should be M&A activity, consolidation in the adjacent industries as well, or the supportive industries, so to speak. And there's going to be a lot of consolidation, for example, in the ag tech industry as smaller companies start consolidating with larger companies. That's already going on.
Yeah, I would also add that I think that there are certain ancillary sectors to just food production generally that have already been consolidating for the last 25 years. So some are pretty far along that process as opposed to the farm itself.
Yeah, and for the farm itself that's got a strong balance sheet, free cash flow is in good shape. This time, like right now, this is like opportunity. This is like Christmas, right? You're in a much different situation than the financially distressed operation that all of a sudden is trying to figure out how are we paying for the fertilizer this next month? Big difference.
Yep.
Absolutely. And it creates opportunities. And I mean, it's unfortunate for those that are on the wrong side of the equation, but the reality is it does create some significant opportunities for the balance sheet, healthy enterprise, and it further perpetuates consolidation.
Well, and the other factor in all of this is international competition. Let's just, I think one of the ones that a lot of people are talking about right now is the growth of the production power in South America and the impact that's having on, like, say, U.S. soybean exports, trying to be competitive with South America. International competition is coming on strong.
Absolutely. And I think that, we try to maneuver our way around it with trade policies and trade agreements and tariffs and a variety of other things. But at the end of the day, it's when you look at the globalization, the ongoing globalization of agriculture, to me, it looks and feels like we're headed more towards specialization, perhaps away from some commoditization. And we got to figure out, as unique regions of a given country, whether it's in the United States, Canada, whatever, where we can be the most efficient, where we can be the most innovative to create that, superior, high quality product that doesn't just rely on consolidation, but it actually, in its own right, allows you to be competitive.
One of the other things you note in the report that I found interesting, and not to get too down in the financial weeds here for the audience, but we're going to talk about EBITDA multiples. And so when a company is sold, a lot of times they talk about the multiple, which is basically just, net income or EBITDA times some sort of like number of 2, 3, 4, 5. And, good for you if you're like some sort of company that gets above 10. But one thing that you've noted is that you're seeing a drop in the ag sector EBITDA multiple since 2021, meaning it's a buyer's market. Am I reading that correct? And if so, why?
Well, I think some of it's been the distress and the reduction in net farm income, at least in the United States. But we expect the market to start to improve, normalize. As Skye says, we'd like to see it sooner than 33 for sure. I mean, our activity on the M&A side, capital raising, et cetera, depends on this. It depends on valuations improving. We believe that they will improve as, things stabilize on the macroeconomic side. And so we expect EBITDA margins to improve. We expect that to be driven by larger revenues and greater profitability.
And how does the price of land run parallel to EBITDA multiples historically? Like, if those margins and those multiples are decreasing, doesn't the price of land have to follow suit, or what does history tell us on that?
So history would tell us that the EBITDA multiple world and conversation that we're having here, it has volatility to it. It's tracked to a variety. It's correlated to a variety of macro and micro economic variables. Land values, on the other hand, are much less volatile and certainly are correlated with certain macroeconomic variables. But even when you see interest rates go from essentially free money to where they are today, we're not seeing that land values, even over a 24-month period of time, changing really at all. Now, if they get up to 10% interest rates, I think we will see land, but we're going to have to see land values decrease. But history would tell us that it takes a lot in the macro environment to make farmland values really meaningfully move one way or the other. They're generally very consistent.
And the other thing here too, guys, is that we haven't brought up is we talked about some of the financial distress out there in farm country, but we haven't talked about the average age of the farmer, and so that ties into this, because if I see a period of financial distress in my sector, and I know that potential distress is a longer runway or is a longer horizon than I'm thinking about being in the business, that may speed up my exit because I'm in capital preservation mode.
Sure.
And so how does the age here fit into some of this M&A activity when it comes to primary production?
Well, we would expect, and this is true in virtually every business activity, that as the founder, the owner, the CEO, as they become of retirement age, they'll start thinking about what next. And some of it may relate to succession planning. I mean, in the ag sector, there's a lot of generational transfer. And there may be younger farmers. Old MacDonald may turn into old MacDonald's son, so it's now young MacDonald, and that may lead to innovation, and that may lead to greater efficiency. But the point is that we believe that the age of the U.S. farmer, at least in the U.S., is going to affect the rate, the level, the volume of M&A activity in the years to come.
We're going to see a lot of volume of activity, is what you're saying.
That's what we would expect, yeah. Simply because of the retirement age, the age of the U.S. farmer.
And we're seeing it pick up already. I mean, it's,
yeah.
Being in the business 20 years, I'd say this wasn't part of the conversation, even prior to 10 years ago. And for the last 10 years, it's becoming more and more a part of the conversation and the reality that we see. We see people that are actually considering these things, looking at their, options. And candidly, in the last 10 years, we've seen a significant rise in institutional capital. It's different in the U.S. versus Canada, tied to laws, ownership restriction laws in a variety of Canadian provinces and United States, specific U.S. states. But the reality is there's a lot of institutional capital coming into the space that's providing liquidity events for these succession planning needs tied to this age of the farm.
So you're getting to my next question here is who is able to do all these transactions? If you have all of a sudden all this supply on the market, who's doing all these transactions? Is it institutional investors, Wall Street, Bay Street? Obviously, specific in there's differences in the U.S. from Canada for sure. Much more, very China ownership of farmland, very sensitive topic in some states. So, who's on the other side of all these transactions? Where's the demand coming from?
Yeah, I let me hit that one in a couple of different quick comments. But if you really dig into China's ownership of farmland, it's this is a hot button topic, but the vast majority of their farmland is tied to them owning one hog operations business in the United States. Most states are very sensitive about that topic. But going on to the other just the broader topic, yes, it's Wall Street, it's Bay Street, it's next door, it's Main Street, it's your next door neighbor. We're seeing, back to the balance sheet comment, a well-heeled farming operation that is successfully transitioning to the next generation, has younger management, older ownership, a strong balance sheet. They're expanding when opportunity presents itself with zero Wall Street money. We're also seeing some of those types of operations partner with Wall Street and Bay Street type money to leverage their own balance sheets and grow the farming operation, but not actually use their balance sheet to do it. And they're just leasing the farm. So we're seeing really all derivatives. It's a false assumption that Wall Street's buying up all the farmland in the United States, because that's literally not happening. It's still under 3%. But they are continuing to buy, where it makes sense.
International activities, some of the multinationals are going to be coming into this market, friendly multinationals other than the Chinese, and large agribusiness. I mean, we're here in Boise, Idaho. We sit at the doorstep of one of the largest multinational agribusinesses in the United States, the Simplot Company.
Yep.
And so those companies have achieved a scale to be able and ready to buy when the market opportunities present themselves.
We've been talking to Jerry Sturgill and Skye Root of Capstone Partners, as you heard, based out of Boise, Idaho. Hey, guys, thanks a lot for joining us here today. Really appreciate it.
Yeah, thank you.
Thanks for having us.